सो कीपिंग दैट इन माइंड, यहाँ पे हम ऑप्शंस का डिस्कशन ज्यादा करेंगे क्योंकि इट इज मोर ऑफ अ option basics webinar. Yes, we do conduct a option advanced webinar as well, but for that you have to join on Wednesday for the very next month. But as of now, we will keep it very simple. Basics discuss करेंगे. In options, we have call and put option. क्या होता है ये call and put option? First is call option. At any point of time, you can buy call option of any underlying. Underlying मतलब if, अच्छा करना क्या है, if you are bullish means if you think that this underlying will go up, you can buy call option. Yes, you can sell that option as well. There is a phenomenon of short selling as well. So call option मतलब आपको तेजी लग रही है तो आप कॉल ऑप्शन बाय कर सकते हैं. अगर आपको तेजी नहीं लग रही है तो आप कॉल ऑप्शन को सेल कर सकते हैं. आपको इतनी सी बात याद रखनी. सेकंड, पुट ऑप्शन. पुट ऑप्शन बेसिकली इज द राइट टू सेल. मतलब इफ यू आर बेरिश मींस इफ यू थिंक दैट दिस अंडरलाइंग विल गो डाउन, देन यू कैन बाय पुट ऑप्शन. एंड लाइकवाइज इफ यू आर सेलिंग पुट ऑप्शन, दैट जैसे माइनस और माइनस को मिला के प्लस बनता है, जैसे पुट मैंने आपको बेरिश बताया और सेल भी बेरिश बताया, तो पुट को सेल करना बुलिश इंडिकेशन है. सो व्हेन यू आर बुलिश यू कैन बाय कॉल ऑप्शन और सेल पुट ऑप्शन. व्हेन यू आर बेरिश यू कैन सेल कॉल ऑप्शन और बाय पुट ऑप्शन. So now we are on to the main index derivatives in NSE. First thing, like I have taken the example of Reliance Industries, but now the slide in front of you is showing example of Nifty and Bank Nifty. As you all know कि Nifty and Bank Nifty markets में indices है. अब इंडेक्स डेरिवेटिव्स में अगर बात करें तो इंडेक्स फ्यूचर्स भी ट्रेड करते हैं. जैसा मैंने आपको बोला कि एट एनी पॉइंट ऑफ टाइम देयर आर 3 फ्यूचर एक्सपायरीज. जैसे इंडेक्स फ्यूचर में निफ्टी का सितंबर फ्यूचर्स है, अक्टूबर फ्यूचर्स है एंड नवंबर फ्यूचर्स है. लाइकवाइज इंडेक्स ऑप्शन में कॉल ऑप्शन और पुट ऑप्शन भी साथ ही साथ होगा. अगेन स्टॉक डेरिवेटिव्स में जैसे मैंने रिलायंस की बात करी, रिज्यूम एसबीआई कैश मार्केट में 600 के आसपास ट्रेड कर रहा है. उसके सिमिलरली स्टॉक फ्यूचर्स में एसबीआई का सितंबर फ्यूचर्स होगा और स्टॉक ऑप्शन में एसबीआई का कॉल एंड पुट ऑप्शन होगा. सो नाउ व्हाट वी हैव सीन ऑलरेडी इज कि कॉल एंड पुट ऑप्शन क्या होता है. दिस इज द मोस्ट इंपॉर्टेंट स्लाइड इफ यू आर रियली वांट टू अंडरस्टैंड options. These are the 4 basic options risk profile. What is the difference? जैसे मैंने आपको बोला कि when you are bullish you can buy call option and or maybe sell put option. But क्या implications है, क्या difference है, कैसे पता लगेगा, ये हम जानने के लिए बात करते हैं. First, buying a call option. When you buy a call option, just keep these points in the mind. First, if you have a belief that the stock will rise, means if you have a bullish outlook on the underlying or the index. मतलब when you think that कि यहाँ से market ऊपर जाएगा, then you can think of buying a call option. Second, risk limited to the premium paid. It is very important or basic thing when you are buying an option, that risk is limited to the premium paid. कैसे? मींस अगर आपको निफ्टी 19,500 पे ट्रेड कर रहा है और 19,600 का कॉल ऑप्शन लेट्स से 50 रुपए के आसपास ट्रेड करता है, इफ यू थिंक that markets are bullish or it may go up, then you will think of buying 19,600 call, which is which is trading at a premium of 50 rupees. So आप वो put call option buy कर लोगे. In that case आपका risk at max 50 रुपीज ही रहेगा. मतलब निफ्टी का लॉट साइज 50 है और 50 रुपए का आपने प्रीमियम बाय किया. सो 50 into 50 would be 2,500 would be the maximum loss किसी भी हालत में, किसी भी सूरत में. So when you are buying an option, risk is limited to the premium paid. अच्छा, we always give this example. बाइंग एन ऑप्शन इज लाइक पेइंग एन इंश्योरेंस टू द इंश्योरेंस कंपनी, लाइक जैसे आप अपना हेल्थ इंश्योरेंस, टर्म प्लान वगैरह कुछ भी अपना बाय करते हैं। सो उसमें बेसिकली आप क्या करते हैं, आप कुछ भी कवर के लिए कुछ पर्टिकुलर प्रीमियम एनुअली या मंथली पे करते हैं जस्ट टू गेट दिस कवर। लाइक व्हेन यू बाय व्हेन यू गो टू बाय अ रेंटल प्रॉपर्टी, सो आपने किसी बिल्डिंग में कुछ फ्लैट बुक किया, सो आप बेसिकली उसको एक एडवांस पे करते हैं कि ये एडवांस है और हम यहाँ से एक्सपेक्ट कर रहे हैं, ठीक है हमें यहाँ पे कल ये पोजीशन मिलेगा, बट ठीक है आपने उसको ले लिया। But for some reason or the other, when you reach your home back and you get to know, आपको पता लगता है कि आपके पड़ोस में कुछ बड़ा सेलिब्रिटी रहता है, या फिर फॉर सम रीजन आपको ये पता लगा कि उस पर्टिकुलर फ्लैट में लास्ट टाइम जो रहा था उसका बिजनेस बहुत अच्छा चला था। सो उस टाइम पे आपको उस फ्लैट के लिए बहुत ज्यादा होगा कि नहीं ये तो लेना ही लेना है। सो दैट विल क्रिएट द बुलिश मोमेंटम फॉर दैट फ्लैट। सो इट इज एज सिमिलर टू बाइंग दैट ऑप्शन कि आपको उसकी आउटलुक अच्छा लगने लगा। अगेन ऑन द कॉन्ट्रेरी, आपको शाम को ये पता लगा कि लास्ट जो हमने फ्लैट के लिए एडवांस पे करा है और वो फ्लैट समहाउ, आई डोंट नो हाउ मच ऑफ यू बिलीव इन ऑल दिस थिंग्स, बट अगर मान लो आपको कुछ पता लगा कि वो फ्लैट आपके लिए अच्छा नहीं रहेगा, सो आप उसको एक्सरसाइज नहीं करोगे उस ऑप्शन बाइंग को। सो बाइंग एन ऑप्शन इज एग्जैक्टली सिमिलर टू दिस। मतलब आपने जो ऑप्शन बाय किया है, आपके पास राइट है उस ऑप्शन को एक्सरसाइज करना है या नहीं करना है। सो व्हेन यू आर गिविंग एडवांस टू दैट एडवांस फॉर दैट फ्लैट टू द ब्रोकर, यू हैव द राइट टू टेक द पोजीशन और लीव इट। सो एग्जैक्टली ऑप्शन बाइंग सेम है। सो कॉल ऑप्शन बाय तब करते हैं जब आपको ये लगता है आपको तेजी लग रही है, और पुट ऑप्शन बाय तब करते हैं जब आपको मंदी लगती है। सो दिस वाज बाइंग अ कॉल ऑप्शन। अच्छा, अनलिमिटेड मैक्सिमम रिवॉर्ड जो थर्ड पॉइंट है उसका क्या मतलब है? मींस यू डोंट इवन नो कि मार्केट कितने तक जा सकता है। सो व्हेन यू आर नॉट श्योर और अनअवेयर ऑफ द मैक्सिमम रिवॉर्ड, और निफ्टी हो सकता है एक्सपायरी तक 19,600 चला जाए, 700 चला जाए, 800 चला जाए, यू डोंट इवन नो कि कितना रिवॉर्ड हो सकता है। सो इन दैट केस वी डिफाइन इट एज अनलिमिटेड मैक्सिमम रिवॉर्ड। सो what are the crux of the story is, when you are buying, when you are bullish, you get to buy call option, और जितना आप ऑप्शन बाइंग मतलब आप जो प्रीमियम दोगे वही आपका मैक्सिमम रिस्क रहेगा। अब सेकंड, सेलिंग अ कॉल ऑप्शन। when you are selling a call option, it means that you believe that the stock will fall or you have bearish outlook. Means Nifty is trading at 19,500 and you are selling 19,600 call with a premium of 50 rupees, let's say. So in that case, like insurance companies, उनका maximum profit जो आप प्रीमियम पे कर रहे हो, जो वो प्रीमियम कलेक्ट कर रहे हैं उतना तक ही है। इफ इन केस उनको किसी भी हेल्थ इंश्योरर ने या फिर टर्म प्लान लेने वाले ने अगर वो एक्सरसाइज किया तो उनको उससे ज्यादा अमाउंट देना पड़ता है। यहाँ पर ऑप्शन सेलर के लिए भी वही है। सो ऑप्शन सेल करने वाले का मैक्सिमम रिस्क वुड बी लिमिटेड टू प्रीमियम दैट इट हैज रिसीव्ड, और रिस्क इज थ्योरेटिकली अनलिमिटेड। मतलब आपने 19,500 पे निफ्टी ट्रेड कर रहा है, 19,600 की कॉल ऑप्शन 50 रुपए में सेल कर दी, थिंकिंग कि मार्केट यहां से ऊपर नहीं जाएगा, बट यू डोंट इवन नो निफ्टी 19,650 भी जा सकता है, 700 भी जा सकता है, 800 भी जा सकता है और 900 भी जा सकता है। जब आपको एक्चुअल प्राइस नहीं पता तो थ्योरेटिकली योर रिस्क इज अनलिमिटेड। So this was writing a call option, means selling a call option. Next, buying a put option. When you have a belief that stock will fall from right now, so then you can think of buying a put option. Second, risk is potentially limited to the premium paid. जैसे मैंने बात करी ऑप्शन बाइंग, चाहे कॉल बाइंग है चाहे पुट बाइंग है, इसमें आपको रिस्क जो है वो लिमिटेड रहेगा जो आपने प्रीमियम पे किया है। in any scenario your loss cannot exceed what you have paid for that buying and option premium, and potentially unlimited maximum reward because you don't even know कि market कहां तक आपकी फेवर में जा सकता है। Last is writing a put option. मींस पुट ऑप्शन जैसे मैंने बात करी माइनस और माइनस प्लस होते हैं, पुट मतलब मंदी और सेल मतलब भी मंदी, तो माइनस और माइनस को मिला के बुलिश हो जाएगा. So when you are selling a put option, it means that you think that market will not fall much from here, or we say you have a belief that stock or market will rise. But risk is unlimited when you are selling an option. So right, चाहे आप call option sell करो या put option sell करो, risk आपका unlimited रहेगा theoretically, because you don't even know आपका risk कितना है. सो जब आपको कुछ नहीं पता है तो वहीं पर आपका स्पेक्यूलेशन या फिर रिस्क स्टार्ट होता है. बट रिवॉर्ड इज लिमिटेड टू द प्रीमियम रिसीव्ड. अच्छा, सो ये तो हमने समझ लिया कि कॉल ऑप्शन बाइंग, पुट ऑप्शन बाइंग, कॉल ऑप्शन सेलिंग, पुट ऑप्शन सेलिंग क्या होता है. अब आपका एक बेसिक सवाल उठ सकता है कि सर कॉल ऑप्शन बाइंग भी तेजी करना है और पुट ऑप्शन सेल करना भी तेजी करना है, सो हम किस सिनेरियो में हम कॉल ऑप्शन को बाय करें या किस सिनेरियो में पुट ऑप्शन को सेल करें. इसका जवाब सीधा सा है. फर्स्ट, इफ यू आर बिगिनर इनटू द मार्केट, जस्ट रिफ्रेन फ्रॉम सेलिंग एन ऑप्शन. उसमें बहुत ज्यादा एक्सपर्टीज रिक्वायरमेंट रहती है, आप ऑप्शन को सेल नहीं करेंगे. बट यस, डेरिवेटिव में इंपॉर्टेंट चीज क्या है, टाइमिंग्स. अब टाइमिंग्स बहुत इंपॉर्टेंट है, बिकॉज आपने कॉल ऑप्शन बाय किया, उसमें ऑप्शंस में हम एडवांस में बात करेंगे कि थीटा ऑफ एन ऑप्शन भी होता है, ऑप्शंस की कुछ टाइम वैल्यू होती है. एज वी हीड टुवर्ड्स द मैच्योरिटी, ऑप्शन प्रीमियम टेंड टू लूज इट्स वैल्यू. तब आपको पता लगेगा कि आपने ऑप्शन तेजी सोची और तेजी हुई, लेकिन आपको ऑप्शंस में पैसे नहीं मिले. इन दैट केस हम ऑप्शन को सेल करने का देखते हैं. But as of now, what you need to understand is call option, buying a call option is very similar to selling and put option, but not exactly same. So yes, so just as of now, focus on buying an option, whether it is call option and put option. There are other ways of doing it also, like deploying some strategies, but yes, that we will discuss into the option advanced webinar. Now the next slide is moneyness of an option. मतलब एक तीन तरीके की चीजें होती हैं. फर्स्ट इज इन द मनी, आउट ऑफ द मनी एंड एट द मनी. जैसे like we are giving the example, Nifty is trading at 18,600. Strike price is, let's suppose, 18,500. So call option of 18,500 strike would be in the money. In the money मतलब 18,600 पे निफ्टी ट्रेड कर रहा है, लेकिन हम 18,500 की कॉल ऑप्शन को बाय कर रहे हैं. मतलब 100 पॉइंट अंदर, मतलब 600 के पहले आता है 18,500. सो कॉल ऑप्शन के केस में 18,500 स्ट्राइक वुड बी इन द मनी. और एट द मनी में निफ्टी 18,600 पे ट्रेड कर रहा है, तो 18,600 की स्ट्राइक प्राइस की कॉल वुड बी एट द मनी. लाइकवाइज, जितना हम स्ट्राइक प्राइस में दूर जाते रहेंगे, प्रीमियम उतना कम होता रहेगा. जैसे 18,600 पे निफ्टी ट्रेड कर रहा है, तो 18,700, 18,800 वुड बी द आउट ऑफ द मनी कॉल ऑप्शन. अब जनरली कॉल ऑप्शन में हम जैसे जैसे दूर जाते हैं, सो जस्ट टू गिव यू पर्सपेक्टिव, जैसे आप 18,600 पे ट्रेड कर रहा है, तो 18,700 की कॉल ऑप्शन की कुछ वैल्यू होगी. उस कॉल ऑप्शन की वैल्यू का कुछ डेल्टा होगा. डेल्टा मींस कितना वो ऑप्शन प्रीमियम चलेगा, कितनी अंडरलाइन के मूवमेंट पे. सो जैसे जैसे आप एट द मनी से दूर जाओगे, बाहर की तरफ जाओगे, डेल्टा कम रहेगा, या फिर वो प्रोबेबिलिटी बताता है कि कितना % चांस है आपका ऑप्शन एट द मनी हो जाए. मतलब टू सम इट इन ए सिंपल लैंग्वेज, अगर 18,600 पे निफ्टी ट्रेड कर रहा है, 18,700 पे अगर डेल्टा 25 का है, सो हार्डली 25% चांस है कि ये 18,700 की कॉल आपकी एट द मनी हो. बट एज ऑफ नाउ आउट ऑफ द मनी है, सो इसके जीरो होने के चांसेस भी ज्यादा है. सो इंपॉर्टेंट क्या है, इंपॉर्टेंट ये है, यू जस्ट टिक टू एट द मनी ऑप्शन. कि आपको, अगर आपको थीटा की या ऑप्शन का डीके का बहुत ज्यादा नहीं पता है, सो जस्ट स्टिक विद द एट द मनी ऑप्शन. मतलब अगर रिलायंस 2520 ट्रेड करे, तो 2520 2530 के आसपास का ऑप्शन को आप बाय करने का देखें. बहुत ज्यादा दूर के ऑप्शन पे जाने का कोई लॉजिक नहीं है. सो दिस वाज मनीनेस ऑफ एन ऑप्शन. फॉर कॉल ऑप्शन अंदर के जो कॉल 18,600 चल रहे तो 18,500 इन द मनी रहा, और 18,600 एट द मनी रहा, और 18,700 एंड बियॉन्ड आउट ऑफ द मनी रहा. बट फॉर पुट ऑप्शन इसका थोड़ा सा उल्टा है. इट जस्ट अ मिरर इमेज. जैसे 18,600 पे ट्रेड करे तो 18,600 की कॉल भी एट द मनी है और पुट भी एट द मनी है. बट जो आउट ऑफ द मनी था वो पुट के लिए इन द मनी है. मतलब निफ्टी 18,600 पे ट्रेड कर रहा है तो 18,700, 800, 900 एंड बियॉन्ड स्ट्राइक्स विल बी आउट ऑफ द मनी फॉर कॉल, बट फॉर पुट ऑप्शन दीज आर इन द मनी. एंड लाइकवाइज जो स्ट्राइक्स करंट मार्केट प्राइस से कम थी, मतलब 18,500, 400, 300 कॉल ऑप्शन के लिए वो इन द मनी था, वो पुट ऑप्शन के लिए आउट ऑफ द मनी रहेगा. So this was all about moneyness for the option. Now for price OI implication, I hand over the call to Manoj sir.
Yeah, thanks Gaurav. So just to sum it up, the basic thing what we try to explain here in this basic understanding of option is there are two types of option. One is a bullish instrument to buy, which is a call option. One is a bearish instrument to buy, which is a put option. So like you buy the stock when you are bullish, or when you like the stock and you are expecting it to be positive, then you buy the stock. The same thing you would, in this case, you would buy a call option. And same when you expect the underlying can be an index, it can be a stock, it can be a currency, it can be a commodity also. So any underlying where you're expecting some bearishness, you can trade by a simple instrument, which is a put option. Now we are just talking about buying an option. Like Gaurav mentioned, buying would be the simpler thing to do for traders who are just new to the market. So at the money is, as the name says, where the market is trading or where the underlying is trading, the options of those levels are called at the money. So for example, Nifty is at 19,500. So 19,500 strike, call and put option is called at the money. The simple way to understand the movement of the premium is, for a call option, if because call option is bullish in nature, if the underlying is expected to move 100 points, usually the premium of the call option increases by 50 points. So let's say if the 9,500 call option is 100 rupees and you are bullish on it, you buy it for 100 rupees and the Nifty goes from 19,500 to 19,600, the call option premium, which was 100 rupees, it increases by 50 rupees and becomes 150 rupees. So that is what is meant by a delta of plus 0.5 for a call option. Same likewise for a put option, it is minus 0.5 because put option gives you money when the underlying or the stock comes down. So that's the basics which Gaurav mentioned. Now there are a couple of other indicators that we try to look into to understand what is the better level, because in derivatives, unlike stocks, there are two things. One is direction, that is if you are bullish or bearish, but the second time is timing or the entry level, because the basic difference between a stock and a derivative is derivative has a time associated with it. Everything comes to an end. At the max, it can be a weekly in terms of option index, or it can be monthly also as per stock and index. So every instrument that you buy, it comes with a strike price if it is a call option or a put option, and third is expiry date. So expiry date is a date at which that contract will become zero or it becomes void. So for example, today was the first weekly expiry for Bank Nifty on 6. So the strikes of all the call and put option that the Bank Nifty any trader has been holding, even after market, that would become equal to the price that it is given. So from tomorrow onwards, we would be entering into the next weekly option. So in derivatives, timing as well as direction, these both things are needed. So how would you help in the timing is, when you see the price of an underlying, let's say if you're talking about a stocks like TCS, if you're seeing the price of TCS going up, and if you're seeing the TCS September futures open interest is also increasing, so in this case, you will say the price is up, open interest is up. So then you can assume it is long built up. The reason why I'm saying assume is because whatever data that we get intraday and what we get in the Bhav copy, which comes in after the market around 6:37 p.m., generally differs, and it differs by a good 40 to 60%. So let's say if you see that TCS was up 2% and the open interest increase was 5%, there is a possibility that in the Bhav copy, it might be just 1%. So that is why we use the word assume. So post we get the data from the bow copy, that is when we ascertain that it has been buying. So a simple way to look into this is when the price is up and the open interest is up, you can assume it is buying. The second thing is when the price is down, but the open interest is up, then it is shorting. So guys, we need to understand open interest is a very simple term. It says that the interest is still open in a trader for that trade. That means if you have bought any call or put option, you're interested in that trade. So you have an open interest in it. So even if you are shorting or if a stock or an index is falling, so decrease in the price, but again, when people are selling it and they're holding their position, they have the interest in the trade. That is when the open interest goes up. So only then we call as short built up. Now, the most important thing is when you are buyer of a call option or buyer of a put option, prudence is, what I mean by prudence is generally most of the time, almost 85-90% of the time, the underlying has to see a long built up or a short built up. So in the first case, when the price is up, open interest is also up. So you have an option to buy a future, or you can also buy at the money call option, like we discussed in just 5 to 10 minutes before. What exactly is at the money call option? Similarly, if a stock is going down or the index is falling down, like the Bank Nifty was doing today, and if you are seeing the open interest also increase, so you can either short the futures now, or you can buy a at the money put option. So this is the basic understanding for a trader who is new in the market. The only biggest difference between an instrument of a future and option is when you're a buyer of an option, whatever premium you buy or you pay for that call or put option, that is a maximum loss, even if you're wrong. But in our futures, there is an M2M. So we are all aware of an M2M that is associated. So it is always advisable to go in for option because the risk is limited and it opens up good amount of profit in terms of multiple, because the premium is usually between 100, so let's say 3, 4, 500 odd points. And at the money option for Bank Nifty usually is not more than 130 to 150, depending on when the expiry is. But still, that is the maximum M2M or the loss you can incur, that too till the expiry date. So even if, let's say, you bought a call option today and the expiry is 5 days from now, even if you're wrong, there would be some premium in that option, but the loss is limited. But if it is a future, the M2M starts the very second or the very moment you enter into a trade. So it is always advisable to be more precise using a option. And once you're very precise with that, and for other reasons, you can select an instrument which is your future. So the first 2 points you can see on the screen, long built up and short built up. This is primarily the case when options are bought. For the first case, it is call option buying. For the second case, it is put option buying. Now we can see the third and fourth, which says that short covering and long unwinding. So these are not follow-up trades. This is square off trades. So short covering means when you have a short position or when you have sold an underlying, but unfortunately the underlying is going against, it is going on the upside, it is going up. You try to square off your position by buying it back. So buying a short position or squaring off of a short position is called short covering. And because the activity you need to do is to buy, when you are squaring it off, the price incidentally goes up. So that is what the third point is. When the price is up and the open interest is down, now because the trade is squared off, so the open interest will be down. So that is short covering. So this should not be used. Short covering should not be used as a indicator to buy a call option, because the third important point, the first is direction, second is time, and the third is you need a follow-up buying to come in, because as I said, every instrument in derivative is time bound. So if there is no follow-up buying, so I'll give you an example. Let's say 19,500 call option you bought for 100 rupees and you saw some short covering in Nifty futures. But then that short covering took maybe gave a 20 points or 30 points bounce in the Nifty. What happens is your call option of 100 rupees might become 105 or 110. Let's say the delta is 0.5. So 20 points is where the Nifty rallied. So your call option will become 110. But what happens after that? If there is no follow-up buying, this 110 eventually can come back to 100. So the first 2 points, that is having a long position with the futures, that is increase in OI, is a must when you are buying, because usually I'm saying when there is an open interest associated with the trade in the direction, the trade goes on. So that is the 20 points in Nifty can become 30, 40, 50, 80, 100, depending on how good the understanding of the data is. So the third and fourth point, that is decrease in the price and decrease in the open interest, which is profit booking, should not really be used to buy an option. These indications should be used to book profit. So let's say you bought a call option and the price was going up, there was long built up, and the price of the call was 100 rupees. But after maybe an hour or so, you are seeing that the price is coming down and the open interest is also coming down, the last point, which is long unwinding. So maybe at 130 or 150 or whatever the premium you got, you decide to square it off. So the first two indicators are used to enter the trade in an option. Usually the third and fourth is used to square off the trade. So now going to the next slide. Put call ratio. Now there are 2 to 3 basic assumptions that we need to understand. In the market, let's say the volumes which is done in the NSE is a good 75-80% is more into your index options, and in the that's in your derivative equity options. And out of that option volumes, almost 75-80% more than that is in the index option. So what happens is generally there are a lot as good sellers as much as buyers. So put call ratio is a simple mathematical way of understanding if the market might be going up or is there a downturn to it. So the basic assumption, the first assumption to a put call ratio analysis is you are assuming that the open interest of the call or the put option, whatever strike we are checking, that is more of selling. You do not assume it to be buying. So that is the first observation, first assumption. The second thing is generally if there is a put call ratio associated with it and if it is carried overnight, only if the market is more or less at the same strike would you assume the same to go on. So I'll give you an example here. Let's say the put call ratio is 1. That means the entire put strike, let's say for a strike of 19,500, the put option total open interest is 1 lakh. Total we are talking about. And even the call option 19,500, same strike, call option, the open interest is 1 lakh. So the put is 1 lakh open interest, call is 1 lakh open interest. So 1 divided by 1 is 1. So the put call ratio is 1. That means it does not give any clear indication as to the market will go up or down. Now the second thing I'd like to elaborate, like Gaurav was mentioning, selling a put option and buying a call option, there is only one basic difference. When you buy a call option, the assumption is you are expecting the underlying to go up. But when you're selling the put option, the assumption is you are expecting the underlying might not go down below your strike price. So for example, if you're buying a 19,500 call option, you're expecting Nifty to go up from 19,500 to 6, 7, 800, whatever is the target. But when you're selling a 19,500 put option, you are expecting that 19,500 would be a support and the Nifty might not really go below that. So the most important part, that is selling of an option necessarily says about a support or a resistance. So if we see that 19,500 put option, the 1 lakh open interest has increased to 2 lakh. Now you would say the put call ratio is 2:1. That is 19,500 put open interest is 2 lakhs and the call open interest is just 1 lakh. So when the put call ratio is 2:1, that becomes the support. And likewise, when the put call ratio is 0.5, that is call option is twice that of put option, you would expect that to be a resistance. Now this is one basic understanding. Obviously there are many parameters to that, but just to sum it up, the most important part is as a new trader, it would be more prudent to look into buying of an option. A call option is a bullish instrument of an option to buy. A put option is a bearish instrument to buy. Second is we should try to look in for at the money because that is where the movement is maximum in terms of premium. And for derivative, the 3 basic to 4 basics that we need is, one is direction of the underlying. Second is direction in the sense if you are bullish or bearish on it. Second is what time, what is the amount of days or how many days are left for expiry, that is the time to expiry. And the third is what type of strike, are you buying an at the money strike or in the money strike, that would be the third thing. And the fourth most important thing in derivative is because it is time bound, entering an option is equally important as exiting an option. So booking profit at the right time is equally important as much as buying an option. So this indication of price going up, open interest going up, and that being a long built up assumption can help buying a call option. The second assumption of the price going down, and again the open interest going up. In both the cases, if you see, whenever you are buying a call or a put option, the open interest has to go up, because that signifies the follow up buying or selling to come in. So decrease in the price with increase in the open interest is an indication of short built up, which is a case for buying a put option. And the third and fourth, which is your squaring of trade. So usually we see a short covering and long unwinding to book your profits. And put call ratio. So when you are not sure as to how much more rally or selling might come in, we try to look into each strike. So the same strike, call and put option, we try to divide just the total open interest of the put to the call. So generally, if you have a put open interest twice that of call, because we are assuming it is selling. So a put is sold when there is support in the market at that strike. A call is sold when there is a resistance in the market. So this would be the main basics that we have. So I guess, guys, if you all have any queries on this basic understanding, please use the chat box to ask. I'll be more than happy to answer that. Swaraj.
Thank you, Manoj. Dear participants, if you have any question, request to type in the Q&A section so that we can address your query right away right now. So there is one question from AR. Why share in F&O is always in range, like Ultratech always is in the range of 5,000 to 8,000. Even if the results are good, they are always in the range. And also when some shares are included in F&O, why they go in downward direction, like SBI Card, Whirlpool, Honeywell, and Automation.
Yeah. So this is from someone with an initial AR. This is a very beautiful question. So let me go ahead and answer this. See, we need to understand the broader understanding. Derivatives was introduced in the market to hedge the underlying from a volatile situation. So what it means is, let's say you have a portfolio of 1 crore, and in one month it is increased by 10%. It has become 1.1 crore. So we are all happy. But what happens when it goes down by 10%? So that time you are reluctant because you are expecting the market to be good, but because of some timely event, the portfolios come down. So you do not want to exit your trade also, but there is no way to cap the loss. So that is where derivatives was introduced, where you can buy some put options like we mentioned, and we can hedge the position. Now the question is, why is F&O always in a range? The most important thing is, in a 12 months year, we have 4 months, 4 to 5 months max, where the Nifty or the Bank Nifty or the underlying is directional. So what we mean directional is, if you remember, almost I guess September, October, from 18,600 onwards, we rallied almost 1,200 odd points in Nifty. But after that, we spent a good 5 months or 3 months in the 19,600 to 19,200. So this is what it is. So 8 months, the market is usually range bound, or it digests the move that happens in the 4 months. So that is the basic statistical thing. So 4 months in a year is, now obviously it is not linear. It can be any 4 months. So 4 months usually. So 1/3 of the time in a year, we have direction in the market. Rest of the time it is range bound. So that is the basic question as to why the stocks are range bound. Because if a stock doubles, let's say we have all the 12 months into one simple rally, maybe a bullish one. So your Ultratech, let's say, let me give you an example. It was 3,000, and in 1 year it becomes 6,000. And in the next year, again, it becomes 3,000. Now, if that happens, obviously there would not be confirmed buying, because when you would traders, not only retail, you need to understand institution, prop desk, and even HNIs, they would invest in an underlying where there is some basic up move, or when there is less volatility, because you do not want your portfolio to be minus 85,000 in 1 day and plus 1,25,000 in 1 day, so that fluctuation will never give you clear direction of the trade. So that is why we have a range bound, usually 8 months, wherein every time some fair value. Now fair value can be found out by fundamental analysis, usually the reports that we come up, or second, it can be a trading bet. So based on these two analyses, whenever the fair value of the stock comes in, that stock either takes a support, or if it is overvalued, it finds a resistance. Now the second question, why do stocks go down when they enter into F&O market? The simple thing is, let's assume that there are a lot of funds and institutions which hold stocks. Let's say a stock like MTNL, which was not in F&O. The stock was at say 10 to 12 rupees. And in 2 years, it became 30, 40 or 50 odd rupees. There were good financials and things were all good for MTNL, and the stock has gone 40. Now, when it enters the derivative market, what happens? It gives an instrument to hedge. Now, because this stock is involved, or it is being bought into a fund, there will be a follow-up buying for that entire year. So there are two types of things which happens. One is called an FA, which is fresh arbitrage, and second is called as a reverse arbitrage. So a simple way is, whenever a stock is introduced into derivative, there is an instrument which is introduced to hedge the position. So to cap the profit, that is from 10 rupees to 40 rupees, the stock has rallied. So to book that profit in a notional way, what you do is you short the futures at 40 rupees. So if the futures comes down from 40 rupees, the futures will start give you money. So every stock, usually after a rally, if it comes into FNO, the funds or the institution or the FI does, they hedge it by shorting the current or next month or the far month futures. And that is exactly why we see the derivatives usually come down. And that correction is not usually more than a 10 to 15% of the rally, because then again the up move would go on, and this shorting, or which is a part of the hedge, that would continue. Just to tell you, you would not hedge 100% of your position, then you'll never make money. So hedge is usually 2 to 5%. So if you have 1 crore of a stock, you would use, let's say, 2 lakhs or 5 lakhs rupees as an M2M to short the futures and carry it to the next one. So that answers that question. Yes, Suraj.
Thank you, Manoj. So we request you to share your valuable feedback. In the meanwhile, we also request you to share your valuable feedback and your questions in the Q&A section. So if you have any questions, request you to type in the Q&A section. We request all the participants to share your valuable feedback. And if you have any question, request you to type in the Q&A section.
Yeah, Suraj, I guess if there are no queries, we can call this webinar.
Yes, let me check once again, Manoj. So participants, if I may ask to share your valuable feedback, request you to share your valuable feedback out here. If you have any question, request to type in the Q&A section. I believe, Manoj, no more questions.
Okay.
Right, we can conclude the session.
Thank
So
you.
Manoj, thank you so much for joining us. Thank you, Gaurav, and thank you all the participants for joining us for this basics derivative session. Looking forward to connect with you once again. With this note, we are concluding the session. Thank you. Have a nice day. Great day. Take care. Bye-bye.